Your parents might be sitting on a financial decision worth hundreds of thousands of dollars right now, and most families have never even had the conversation. I'm Jay. Welcome back to Maple Money Mindset, and today, we're talking about something almost nobody under 50 thinks about: reverse mortgages. Here's why this matters right now. I'll be honest, before researching this video, I had no idea how massive this market had become. Canada's reverse mortgage market has quietly grown to almost $11 billion, growing at an average rate of nearly 21% every single year for the past decade. That's not a small trend, that's an explosion. And if your parents own a paid-off home in a major Canadian city right now, there's a real chance someone has already approached them about this, or will soon. So before you have this conversation with your parents, you need to understand exactly what you're talking about. A reverse mortgage lets homeowners aged 55 and older borrow against their home equity, with no monthly payments required. The loan gets repaid only when they sell, move out, or pass away. Interest builds up quietly in the background the entire time. In Canada, the biggest player by far is Home Equity Bank with their CHIP reverse mortgage. You can access up to 55% of your home's value completely tax-free. It doesn't affect old age security or CPP payments. And you keep full ownership of your home the entire time. Sounds appealing, right? And for a lot of retirees, it genuinely can be. But here's what almost nobody explains clearly. The interest rates are significantly higher than a regular mortgage. As of 2026, CHIP rates range from around 7.24% on a 5-year fixed up to 7.59% on a 1-year fixed. Compare that to a regular mortgage sitting around 4.5 to 6% right now. That gap exists because the lender is taking on more risk. No payments coming in, and they have to wait years, sometimes decades, to get their money back. And because there are no payments, the interest compounds quietly every single year. Let me show you what that actually looks like. On a $200,000 reverse mortgage at 7.5% interest with zero payments made, the balance can grow to over $287,000 in just 5 years from compounding interest alone. That's the part families don't see coming. The home doesn't lose value necessarily, but the debt against it grows faster than most people expect. So, is it a bad deal? Not necessarily. Here's where it actually makes sense. If your parents want to stay in their home, don't want to downsize, need extra cash flow for retirement, medical expenses, or even just enjoying life a bit more, a reverse mortgage can genuinely improve their quality of life. Home Equity Bank's own numbers show that on average, their customers still have over 50% of their home's value remaining even after the loan gets repaid. And there's a no negative equity guarantee, meaning your family will never owe more than the home is actually worth when it's sold. That protection matters. But here's the conversation every family needs to have honestly. If leaving an inheritance matters to your parents, a reverse mortgage reduces what's left for you and your siblings. That's not a flaw in the product. That's just math. The equity they tap into today is equity that won't be there tomorrow. That's not something anyone wants to think about while a parent is still healthy and active, but avoiding that conversation now often makes it harder later. There are alternatives worth comparing too. A HELOC typically charges 1 to 2% less in interest, but requires monthly payments your parents may not want or may not be able to make. Downsizing avoids interest altogether, but means leaving the home they love. Every option has a real trade-off, and none of them are automatically right or wrong. And here's something practical most people don't know. When your parent passes away, the estate typically has a limited window to repay the reverse mortgage, often by selling the home. If that timeline feels rushed during an already difficult time, that's worth discussing now, not after. So if you're an adult child reading the signs that your parents might be considering this, or if you've noticed reverse mortgage ads targeting them constantly, have the conversation early. Ask what they actually need the money for. Compare it honestly against the alternatives, and make sure everyone understands what it means for the home and for the family. Years down the road, don't wait for a hospital visit to start this conversation. Start it at the dinner table instead. If this helped you understand something your own family might be facing soon, share it with someone who needs to see it. Thanks for watching Maple Money Mindset. Don't forget to like, share, and subscribe for more simple and practical content just like this.